Hey traders, this is Luke Myers. Wanted to make a quick video, go over today's action. The morning, actually pretty much almost a large majority of almost all the mornings this week have been really bad as far as trying to trend trade. Very volatile, very sideways, and not really finding a whole lot of trend to the afternoon. I actually just spent a little bit of time making some notes on my trades, or potential trades I should say. And the afternoons, which is typically a very bad time to trade, it was completely reversed this week. If you would have traded in the afternoon, you would have made most of your money and would have lost most of your money in the morning. So it's been a very unusual week. I only trade the morning because generally that's highest volume, highest probability. So I've had a pretty tough week. Obviously, when swing trading, you're going to make money on pullbacks. The key is being able to filter out bad trades. The number one best way to do this, in my opinion, is through using divergences. Some people use discretionary methods using support and resistance. That is really not a style that I can do because it's too left up to judgment. It's not very clear. It's not like, okay, well, it went exactly to this area or roughly to this area. We're not going to take any trades here. This is an example. This whole area right here where I'm drawing this box was like a sideways supply and demand area. And then you can see, you can't really see on this side of the screen, but we eventually did, let me show you over here. We eventually broke well through it. So if you're going to do something discretionary, you're going to see that it breaks through in here, and you might start taking some swings. You can see there was some continued kind of overhead resistance here, but eventually you break through it, and then you're like, well, what do you do here? I mean, do you not take this swing? So for me, that's why it gets problematic, because there's too much really left up to guesswork. Some people can do it, and that's fine. But I need a clear rules-based strategy. So I have two systems. One system uses a 50-period exponential moving average. It's a Keltner channel with a EMA at the center, and an MACD. And basically I trade swings. This works just well, just fine. Another system that I have doesn't use the Keltner channel bands, but does use a 50 EMA. Has a kind of little band. The green lines are kind of high-low of the 50 EMA, kind of an area that's acceptable to buy or sell. Call this my wholesale area. And then I use basically a 200-period moving average as like a filter. Now, in good trending markets, it's really good at filtering out some chop. But in sideways markets, you'll miss signals. So, like any fixed rules system based on indicators, under certain types of market conditions, it's going to have limitations where it's just not going to work. The reason being is because it's designed to work really well under certain types of market conditions, i.e. trends, and when there's not very much trend in the market, you're not going to get as many reliable signals. So here's an example of what I mean. We'll go to the afternoon because there's a solid trend here. So you see you can see this pullback right here. This was the last swing low. That would have been an area, according to price action, that you would have looked to start taking a short trade. So you can see price hit this area, found support, never made a new high, and then pulled back down again. Right? So seeing that, you would have wanted to go short. All these shorts that went short in this area here would have got squeezed. Would have had losing trades. So this price action system would have failed you under such conditions. Now, if you're more of a discretionary trader, you could have said, well, there's strong support right here. It's bouncing off of this support. So that, again, is what comes down to discretion. Now, there are some very good discretionary traders. This is a very clear and easy to see example. But many examples are not so clear and not so easy to see. What if it moved down even further, like down into here, if it wasn't just a clean kind of tick? What do you do then? Is it a trade or not? So, there's not easy rules under a lot of market conditions, because as you know, price is always changing. And the problem with discretionary trading is that the patterns, the type of price environments, can be really different, really clumped together. Sometimes it's hard to see. That's why discretionary trading can be problematic. Now, it's good to know these principles, because it's good to know how to apply them. So if I was trading this and I wasn't using this 200 period moving average, so let's say I was using this system here, you would have seen that this was a pullback, but it wasn't really strong. It didn't touch the blue line. It wasn't a real heavy pullback. So you want to say, well, where's the real clear area of support? You say, okay, well, it's right here. Okay? And you say it was pulling back to that area, and now it's pulling back for a swing. I'm not going to take that. That was a good decision to make. But then look, this trade here would have failed. Let's see, 730, 550, 650. Yeah, that would have been a stop out right there. You would have been stopped out. Now, if you look at momentum, you can see that, let me zoom in on this. You can see that momentum was making a new low. You see this red line, see how it's high here and making a new low here. Now, one of the problems with trading divergences is they're not always super clear. So there is a judgment call that you have to make. But generally what you want to do is it's either higher or it's not. If it's not higher, don't take the trade. You only want to take trades that are clearly meeting your criteria. You're going to have many trades that aren't going to meet your criteria. Matter of fact, the more trades that don't meet your criteria, the better, because it means you're filtering out a lot of bad stuff. Generally, you can have a pretty high win rate if you're in a trending market and you're reading divergences and you're reading your system correctly. So you would have seen that this has made a new high. If you're trading just with price action, you would have been stopped out. But if you're using momentum divergences with the MACD, you would have seen that momentum was making a new low. That would not have been a valid trade entry. You would have seen price pull down, found support like right here, and then it bounced back up again, made a new high. Of course, this was a lower high, and this one actually worked out. Now, generally, I have a rule that with my trading that I've come to find. If you have a divergence, this, according to the rule of divergence, means you should expect weakness and a new downtrend should start forming. If you don't get that, the next trade to look for is a dip pop. And a dip pop is any time price does not fail to make a new trend and instead breaks to a new high. Under such conditions, you take the first pullback. I've noticed it generally high probability, 65% plus, if taken properly. Sure enough, we had a dip pop right here. That would have worked out. Now, I don't want to make this video too long, so just kind of going over some basic principles and concepts how to trade. We were asking, well, why do I have two systems? It really depends on my personality at the time. This will catch a lot of stuff because you can trade with price action really well, and you can see the trends. There's also a principle which I like to follow, which is called the power of the first swing. If you're using price action, you can see you had a new trend here. If you're using price action, the first pullback of all new trends generally high probability over a long number of trades. Now, on a day-by-day basis, that's not always correct. So, you kind of got to go back and forth on when you use the principle and when you don't. So here's a great example. Starting out today, it was just a blender out there. So right about, let's see here, right about here, this would have been market open. All right. Sorry about that. Just going to remove that. So this would have been market open, and you could have seen, I actually saw that there was a supply or a support area right here, and we broke right through it. So I was almost going to take this trade, but I saw this divergence forming, and I said, you know, that's a really strong divergence. I'm not gonna enter here. You know, I usually, if there's a divergence on the first trade of the day, especially if it's like 3 minutes out of the open, I almost never take it. The reason being is because I don't like my first trade to be a loser. It's just how I am. You know, the pattern should be clear, and divergence should always be with the trend. That's generally the rule that I generally go with. Now up here, the only reason I took this trade, and I was very skeptical, and actually it probably was a mistake on my part, but momentum made a new high. Price broke out strong here. I thought, you know, I knew we were at a very strong pivot area in a higher time frame. I knew it was probably going to be an up day, which it ended up being an up day. But you know, I saw this price action. I saw it pulling down. I said, you know, this is just really kind of a bearish-looking momentum. It's just grinding. There's some kind of, you know, resistance here. But you know, you look over here, you have the same kind of pattern. This one worked out. So I thought, you know, we could get a touch and a pop. When this failed, I was quite disappointed. You look at momentum, and if you really use momentum properly, you can see that, you know, price action broke out, and momentum broke higher. But look, momentum was higher than all these other three, but price didn't make a new high. That's a bearish signal. You know, for a new high in price, you want a new high in momentum. If price doesn't quite make a new high, you want it to be higher than the last high, but you don't want it to be higher than all these others, than these. And so from a pure momentum standpoint, you really wouldn't have wanted to take this trade. There was a couple of things that were signaling not to take it. For the negative divergence here, the price action, and really those two things. Anyway, this was a failure. And then this trade, according to the first swing principle, should have been taken. But what I've found is you get a zigzag pattern in sideways markets. And because usually if there's going to be a trend in the morning, which is the highest chance of a trend, it's usually going to trend all morning. There's going to be a downtrend, it's going to keep on going. And then you might have one reversal, so you might get a big V for the whole morning. That's it. Those are the days that you want. A solid trend, or a trend down, a trend up. If within your first 15 minutes you're already looking at a zigzag pattern, it's telling you the day is going to go choppy. So I just stayed out of this trade right here. I wasn't even going to take it. And if you look at momentum made it all the way down to this area right here, to this, equaled this low. And but look at how high price was. That is what you call a hidden bullish divergence. Now, hidden divergences are something that you got to learn if you're going to specialize in reading market momentum and supply and demand of the market with momentum. Now, it's a tricky thing to learn. You don't always want to go with these types of patterns. The times that they're most important is when you're going sideways. Now, this zigzag made me stay out. We did have a pop up here. And that was encouraging. I actually almost got back in right here. But then I saw this divergence. And I said, you know, we're zigzagging, we're choppy, and I'm already getting a bearish divergence. There's been a lot of failed trades. I'm going with the divergence on this one. And I stayed out of that too. And of course we ripped down. And then by then I was just really done. You know, because I just know from prior experience that, if a day starts out choppy, it's usually going to continue choppy. So anyway, that's it. Happy trading.